Hi, I'm Ashi, the founder and CIO at IME Portfolio Managers. In today's presentation, I'll take you through the investment thesis of IME Digital Disruption, the first and only pure play listed digital PMS strategy in India. What makes the strategy so interesting is the tremendous level of value migration that is taking place across industries towards digital platforms, making it the fastest growing segment of the Indian economy by a wide margin. Over the course of today's presentation, you will gain a detailed perspective on our investment thesis and what makes us believe that digital platforms are likely to be the theme for the 2020-30 decade in India, similar to how 2010 to 20 was a tech decade in the United States. With that background, let's jump right into the presentation. The first slide gives you a flavor of the current universe of listed digital platforms in India, as well as a future pipeline of digital businesses expected to be listed shortly. This gives you a sense of the kind of companies that this strategy will be focusing on. In order to understand the strategy, it is important to understand a few key points of our investment approach. Firstly, this is a pure play strategy with no style drift. We invest only in businesses that are born digital and platform led. We will not include traditional businesses that simply use digital as a tool to improve their operations or distribution. The strategy follows a private equity style approach to listed investing. This will be a concentrated portfolio with a long term buy and hold mindset, focused on the expected winners amongst digital platforms. We have a clear stock selection framework. We focus on platforms that have disrupted traditional models, achieved meaningful dominance and scale, and built strong competitive barriers to entry. In simple terms, we want a clear right to win and a clear path to supernormal profitability over the long term. While we are very confident about the long term value creation, it's also important to acknowledge that timing the market's recognition of that value can be difficult, and these stocks can remain volatile in the near term. We strongly recommend investors view this as a long term allocation. Its performance will be quite different from a typical diversified equity strategy. And finally, while this is a buy and hold style approach, it is actively managed. Portfolio weights will evolve and exits can happen based on changing market conditions, industry structures, or company level developments. Now, let's understand why this strategy is so relevant for investors today. In India, public market investors still have a relatively weak understanding of how to value digital platform businesses. A large part of the confusion comes from the fact that many of these companies have been loss making for extended periods. And because of that, investors question the very viability of the business model itself. The reality is that you cannot value these businesses using traditional near term profit based valuation multiples. Valuing platforms require building long term earnings models, essentially asking when will these businesses turn profitable? How strong can profitability become? And what does that imply for the value of the business today? Because of this, sentiment, interest rates, and near term macro conditions can have a disproportionately large impact on their valuations, which create high volatility in the near term. This volatility creates a practical problem for most traditional fund managers. If you are judged quarter to quarter or year to year, it's hard to hold meaningful exposure to companies that can swing sharply in the near term, even if the long term story is strong. That is one major reason why, if you look across the broader equity mutual fund universe in India, exposure to listed digital platforms has historically been extremely low. At the same time, the other route to participate in digital has been the unlisted space, venture capital, private equity, pre IPO deals. But many investors are not comfortable with the risk illiquidity and valuation opacity that comes with unlisted investing. So we end up with a clear disconnect. Investors have very low exposure to what is arguably India's fastest growing and most transformational segment. By being a pure play listed digital strategy, we aim to help correct this underrepresentation and give investors a structured way to build exposure to digital platforms. Before we get into the actual investment thesis, let us first have a quick look at the portfolio performance till date and its current composition. This is not a new strategy, but a strategy launched by me in Feb 2023 as CIO for IME strategies at Valcreate PMS. We launched this strategy at a time when there was absolute panic and disbelief in digital platforms, with the stocks having corrected by more than 50% from their IPO prices. Our detailed analysis and research in the space give us a great deal of confidence on the longer term profitability of these business models and just how valuable they are likely to be over the longer term. This strong aggressive contra call paid off tremendously, with the strategy delivering a 130% plus absolute return in just over 2.5 years since launch, making it the fourth best performing PMS strategy out of 379 PMS strategies on PMS Bazaar as of 30th September 2025, the date of the transition from the Val Create to the IME PMS platform. While the strategy remains a highly concentrated strategy, with the top five weights accounting for 80% of the portfolio, it is diversified in terms of industry allocations, giving investors access to India's fastest growing companies across fintech, insurtech, hyperlocal, horizontal, and vertical e commerce, amongst others. In terms of how we'll proceed today, there are three parts. Firstly, we will explain how digital platforms work. Their business models are fundamentally different from traditional businesses, and we will cover the four stages of evolution for platform businesses, including why losses can have such great strategic value in early stages and really lay the foundation for disproportionate value creation over the longer term. Secondly, we will show that digital platforms are not following some new or unproven idea. Rather, they are following a well established and a proven global playbook. Invest heavily first, grow rapidly, then monetize and turn profitable, leading to significant value creation. Thirdly, we will explain why we believe India is set to follow the same path, where growth is clearly evident. The path to profitability is far clearer than many investors assume, and value creation becomes a natural outcome as profitability emerges. Let's start with the first part, understanding digital platforms. A digital platform or network business is simply a business that connects two or more mutually dependent groups of participants in a way that creates value for all sides. For example, you can think of buyers and sellers, drivers and riders, merchants and customers, or creators and viewers. Platforms can be one sided, two sided, or multi sided. To build any platform business, companies typically go through four distinct stages of evolution. Stage 1 is about solving what is called the cold start problem. Stage 2 is about driving consumer behavior and establishing dominance. Stage 3 is where economics begin to transform and profitability starts to emerge. And stage 4 is where platforms can generate supernormal profits and long term value creation. Let's break these down. Stage 1, solving the cold start problem. Every platform starts with the same chicken and egg challenge. Users will only join if the other side is already present. Take ride hailing as an example. Customers will only use the app if enough drivers are available, and drivers will only join if enough customers are using the app. A multi sided platform requires critical mass on both sides before the network can truly work. When you are starting from scratch, the only way to solve this is through aggressive investments. Platforms make the service extremely cheap for users and often subsidize the ecosystem, paying incentives, offering discounts, or even effectively paying salaries to bring participants onto the network. From a funding perspective, this is typically where companies are in seed, Series A, or early stage funding rounds. Both globally and in India, you saw platform businesses offering either free or heavily discount services while in stage 1, where the aim is getting users to the platform. Once the platform has momentum, it enters stage 2. Stage 2, behavior change and dominance. In stage 2, the platform has two priorities. The first is to make the new behavior habitual, so entrenched that users find it difficult to go back to older methods or to shift to competing platforms. The second is to ensure that platform ends up as one of the top players in the market. Network businesses naturally tend to evolve towards winner take all outcomes, monopolies, duopolies, or tight oligopolies, because users tend to gravitate towards platforms that have the highest number of participants. Until a platform has achieved both user stickiness and a durable market position, it typically does not shift focus to profitability. Because the prize is much bigger, the goal is to become one of the few enduring winners. From a funding perspective, this is often taking place in Series B, Series C, pre IPO, and into the IPO funding rounds. Globally, you can remember the period when platforms began early monetization but still stayed light on ads and heavy on growth. In India, when platforms were in this stage between 2016 and 20 for some of the more dominant platforms, ride hailing remained heavily subsidized, food delivery remained discount driven, and payment remained cashback driven. In stage 2, platforms are still spending aggressively to reinforce behavior and build dominance. Once user behavior is entrenched and dominance is established, is really when platforms are comfortable entering stage 3. Stage 3 is where economics truly transform. Stage 3 is where platforms begin to focus on improving profitability, and economics can change quite rapidly. Three major things happen here. One, pricing power improves substantially. Platforms introduce new fees, improve take rates, and monetize more effectively. Two, customer acquisition costs decline. The heavy discounts and incentives that were to drive behavior reduce dramatically once behavior is entrenched. Third, operation leverage starts to play through. Many costs are fixed or semi fixed, and as revenues grow, these costs fall sharply as a percentage of revenues. In India, we've started to see this transition very clearly. Prices have increased in ride hailing, delivery fees have been introduced in hyperlocals, discounts have reduced, and cashbacks have largely been replaced by more targeted offers. This is not an exception, it's a standard global platform model. In simple terms, platforms invest upfront to get you habituated. Once you're habituated, and once the platform has dominance, monetization becomes much easier. And if you ask yourself honestly, is it realistic to go even a few months without using any digital platform at all? No ride hailing, no delivery app, no digital payments, no messaging, no streaming. For many people, it would seem almost impossible. That is the power of behavioral entrenchment. And this is what makes monetization so strong and so durable. Finally, as stage 3 progresses, platforms can enter stage 4. Stage 4 is a phase where you make supernormal profits and aggressive long term value creation. Supernormal profitability emerges because platform models have structural advantage. Firstly, the marginal cost of serving an additional customer or transaction is often far lower than in traditional businesses. This makes it extremely hard for traditional businesses to compete at scale. Secondly, barriers to entry become huge. A new entrant a new entrant would need to spend hundreds or thousands of crores to repeat stage 1 and stage 2 from scratch, and becomes very hard to raise the kind of capital when incumbents already exist that have dominance. This combination creates the potential for long duration, high quality profitability. Now, to simplify these stages in simple and practical terms, think of platform economics over time by customer cohorts. Early in a customer's life cycle, the platform often loses money on that customer because it is investing to acquire that customer and shape behavior. As the customer matures, incentives reduce, pricing improves, and the customer becomes profitable. Over time, you get a predictable recurring revenue and profit stream from that customer. Now, it's important to understand that within the same company, different customer cohorts can be at different stages. Some customers may be mature and highly profitable, while new customers in newer markets may still be subsidized. As more cohorts mature, the company level economics shift towards profitability. The framework also explains why different forms of digital investing have different risk profiles. Until now, many investors access digital through venture capital and private equity. This typically gives exposure to companies still in stage 1 or stage 2, where right to win is not yet proven, unit economics may not yet be clear, and failure rates are meaningfully higher. Pre IPO has somewhat lower risk, but still has companies that are mostly still operating at level 2 and have not yet entered the monetization phase. There are also additional uncertainties about timing and execution of listing. The listed opportunity is different. Most digital companies do not come to the public markets until they are in late stage 2 or early stage 3, where dominance is better established and the focus is shifting towards monetization. This means the risk of failure is substantially lower in listed digital investing than early stage unlisted investing. This combined with a rigorous stock selection criteria focused on the expected long term winners makes the IME digital disruption PMS strategy the lowest risk method for investors seeking to participate in digital investing. Now that we have understood the four stages of digital platforms, let us see how this is actually nothing but a well established and a proven global playbook. Globally, digital leaders followed a consistent pattern. They invested heavily upfront, often at significant losses. These investments drove rapid adoption and large scale growth. Once they achieved dominance, they shifted to monetization. Once tech companies in the US shifted to monetization, the sheer level to which earnings exploded surprised all market participants. The level of earnings outperformance of tech companies to the broader market has happened to levels never previously seen in markets. This can be seen both at an overall tech earnings versus the broader markets, or even for specific tech versus non tech competitors. This combination of huge scale and an aggressive improvement in profitability is what has led to the disproportionate value creation by technology companies over the last decade. This can be seen by the substantial outperformance of the Nasdaq to broader market indices, as well as of tech companies to traditional businesses in the same space. And you saw a structural shift in market leadership, where digital companies became the largest blue chip franchises in the world. As of 2020, 9 out of the top 10 are tech companies, and the tech sector has started to dominate major global indices. This leads us to the second and a very important question. Can these companies become profitable? And if yes, just how profitable can they become? To answer this, you have to separate structural costs from stage driven investments. If you compare the cost structures of digital companies to traditional consumer businesses on just two cost line items, ad spends and employee costs, you will see the sheer magnitude to which digital companies are outspending traditional businesses as they are in the hyper growth phase. Very importantly, there is nothing in a digital platform's business model that requires these spends to be higher than traditional businesses once these businesses mature. Instead, the heavy use of technology to simplify operations should actually lead to lower cost than traditional businesses over the longer term. A deeper dive into cost line items show most digital companies spending disproportionate amounts in what is clearly linked to hypergrowth investments. Examples include availability fees in hyperlocal platforms, payment processing fees in fintechs, or the huge advertising costs in certain platforms. As these platforms mature, these costs can reduce substantially. Importantly, this is not just a theoretical future outcome. Many listed platforms have already demonstrated clear profitability improvements over recent quarters as they shift into monetization. This shift towards profitability has already surprised most market participants, even as they are still in very early days of their monetization strategy. These companies also come with strong competitive advantages in their respective markets, which should be key to help the very high levels of future profitability sustain and not get eaten away by competition. This leads to our final point: what makes us so confident of value creation? Effectively, if growth continues and profitability emerges, value creation becomes a natural outcome. We have already seen substantial value creation in India's digital ecosystem, including in the unlisted space. But the bulk of early unlisted value creation typically went to global venture capital and private equity investors because access was difficult for most Indian investors. As more companies list, Indian investors finally have a more accessible route to participate in the tremendous value creation of digital platforms without having to be exposed to the very high levels of risk of unlisted investing. This broadly covers the investment thesis for why listed digital platforms can be an attractive investment opportunity. Let me close by quickly explaining how we think about stock selection and portfolio construction. We are not investing in early stage companies. We focus on companies that have already listed, which generally means late stage 2 or early stage 3, where dominance is more established and the focus is shifting towards monetization. Within that universe, we apply a rigorous framework. First, we want clear evidence of dominance and competitive barriers to entry. Ideally, the company should be one of the top 1 to 3 players in its category and should be following the digital network playbook. Secondly, we want large addressable markets so growth can sustain for many years. Third, we want clarity on unit economics and a credible path to profitability, pricing power, cost reduction potential, operating leverage, and operating efficiency. Fourth, we look for optionality, the ability to monetize an existing user base through adjacent business lines. This can create additional growth and profitability without starting from scratch. And finally, we build long term models under conservative assumptions. For us to invest, even under conservative assumptions, we should see attractive long term return potential from today's price. In terms of portfolio construction, this will be a concentrated portfolio, typically in the range of about 7 to 15 stocks, depending on the size of the listed universe and the opportunities available. Even though it is concentrated by number of stocks, it is diversified by business segments. Because you get exposure across finance, consumption, logistics, B2B, and software. You're not buying a single sector, you're buying a business model, digital disruption across multiple segments. The strategy will be long term and buy and hold in mindset, similar to how private equity invests, but it remains actively managed. We will adjust weights as economics evolve, and we will exit if the network value deteriorates or if competitive dynamics worsen. It is also important to acknowledge the risk. Valuation remains complex because many companies are still in the process of moving towards full profitability, and that can keep volatility high. Timing of value recognition can be uncertain. Long term outcomes may be attractive, but 1 year or 3 year performance may vary. Business risk exists. Profitability timelines can extend, customer loyalty can be weaker than expected, new disruptions can emerge, and governance and founder ownership structures can differ across companies. This is why active management and disciplined portfolio construction matters to participate in the upside while managing these risks thoughtfully. To summarize, digital platforms follow a proven model. They invest heavily upfront to change behavior and build dominance. Once behavior is entrenched and dominance is achieved, they monetize, and profitability can rise sharply. We have seen this play out globally. India has the foundations to follow a similar path over the coming decade. A pure play listed digital strategy provides investors a structured way to participate in this theme with lower failure risk than early stage unlisted exposures, provided stock selection is disciplined. Thank you for listening. If you'd like to discuss the strategy further, you can reach out to us via our website, imepms.in, or WhatsApp us at +91 8088 770050, and we'd be happy to connect. Thank you once again.